My name is Andrew Stotts, and I want to welcome you to the Valuation Masterclass Bootcamp final midway through the course presentation. And we're going to be getting a presentation from one of our students, Nilesh, who's going to be presenting on the company Fastenal. I'm looking forward to seeing it. I know he's been working very, very hard to get this together. So let me bring him up here. Nilesh, are you ready to present?
Yes, sir.
Okay. I'm going to share the screen, and now I'm going to the audience can see your screen now. So I'm going to leave here and you can start as soon as I leave. So here we go. I'm leaving now. Go ahead and start.
Okay. So markets reward the companies that consistent and predictable performance. And Fastener is a strong example of that. Good morning, I'm presenting my investment thesis on Fastener. I initiate my coverage on Fastener with a buy recommendation based on a target price of multiplying an upside of 12%. I derive my target price from a DCA based valuation of 7% and a terminal growth rate of 3, understanding the core drivers. So Fastener generates around $8.2 billion in revenue, primarily serves manufacturing and construction customers. The key differentiation lies in its embedded distribution model. Let me briefly explain the three key stories that I make my valuation. So, first story is embedded supply network to drive recurring revenue growth. On-site locations placed directly with facilities. This shifts the demand from periodic ordering to continuous consumption. 70% of the revenue coming from manufacturing customers and international markets, contributing 15% of sales. There is meaningful room to scale these programs across its thousand and plus active customers. The second story is channel makes shift to expand margins. Generate around 2 3 times the higher revenue per location, reflecting a deeper solutions can reduce the inventory consumption by 20 to 30%, improving efficiency. I believe that this shift will 200 BPS, getting margin expansion for faster over the medium term. Then the is customer integration strengthens competitive moat. The fragmented market, which is valued at $140 billion, where scale provides a competitive. The diversified customer base with no customer contributing more than 1% of the revenue reduces the towards the pricing discipline that Fastener has. Additionally, Fastener maintains operating margin of 20% plus roll over and customer retention. I believe that these factors will the market share and support growth in the 30 margins in 30 to 30% over the long term. Moving on to the industry analysis, the industrial distribution sector is $9 trillion to $13.5 trillion. North America contributes about 42% in this. Branches still account for around 80% of the model, while e-commerce is growing at a faster towards hybrid. Now, moving happened in the last quarter. Farnell reported revenue of around dollars, growing at 11% year. However, margin declined by around 5% and EBIT declined by quarter on quarter. ROIC also declined to 31%. So while growth remains, looking at what the other investors which around 44% of have a rule recommendation that average price, market price, target price $2.6, implying a slight from 7% to 6.5%, while looks slightly from 20.2% to 21%. This indicates that a cautious expectations from the market. The Fastnell has a very diversified portfolio, driving its stable recurring revenue. The largest share of revenue comes from the non-hardware and non-safe for about 43% of the total revenue. The hardware contributes and contributed by safety. We can also see here that the Fastnell's maximum sales are in the United States, which is around 83%. The next are Canada and Mexico, which accounts for 13% of its total sales. Now, ranking Fastnell on the basis of the four elements that a strategy offers is Fastnell ranks strong fundamentals and best margins and low leverage. Valuation is below average due to premium pricing and momentum. The profitability and asset efficiency are very strong in case of France, while the growth remains moderate but stable. Expense control is disciplined, and therefore we can say that the profit growth in case of Fastnell is commendable. Now, looking at the profit and loss statement, revenue has shown a consistent growth reaching over $8 billion annually. Margins remain strong with gross of 44 to 45%. EBIT margins around 20% and net margins around 15%. Despite the recent cost pressures, are still indicate a stable to slightly improved margin going forward. This reflects strong operating performance. Now, moving on to the back side of the balance sheet. The total assets have grown steadily in line with the business expansion. This growth is driven by investments in the vending machine, on-site locations, and working capital. The increasing asset base supports the revenue and operational safety. Looking at the liabilities and equity side of the company maintains a strong capital structure. Debt accounts for 20% of the capital total, while equity remains the dominant component. Low leverage supports the financial stability and reduces risk in case of Fastnell. Moving on to the cash flows and where the cash flows come from. Cash flows being the more strong and the consistent part, which have increased and show a dominant increase in the coming future as well. These cash flows are the reason why Fastnell will be able to grow and support its other operations as well. These cash flows are being used in financing terms, financing Fastnell, paying them to the shareholders. Now, moving on to the key ratios highlight a strong performance, which remains high around 30 to 40, 30 to 35%. Return on S is also strong, supported by the efficient asset utilization being stable and reflecting operational efficiency. Recent shows some pressure due to rising costs. However, overall performance remains strong and consistent compared to the peers. Now, the free cash flows remain strong and stable over time. Is the reinvestment into growth and initiatives and strengthen the valuation. This consistent cash generation is a key driver of long-term. Moving to the relative valuation and seeing how the peers are performing in the sector. On a price-to-book basis, Fastnell appears expensive compared to the peers. However, it delivers a return on equity of around 35%, which is significantly high. This justifies the part of the premium valuation. On a price to earnings basis, Fastnell also trades at a few levels and global peers. He is expected to remain strong for 2027. However, the premium impact expectations are already high. Moving for valuation, I use a WACC of 7% and a terminal growth rate of 6%. The DTM gives $4, FE gives $4, and cash flows gives $51. I base my recommendation on the free cash flows model, the DCF valuation leading to a 5 to 12% upside, leading to $51 expected market. The sensitivity analysis also showed Fastenal is a growth company and value sensitive to the growth and margin assumption. Small changes in these inputs can significantly impact the target price, making the execution a very critical part. Moving on to the main of the analyzing the risks that Fastenal could have. The key is include lower revenue growth, margin pressure, lower adoption of embedded supply, and customer pricing pressure. These factors could impact both performance and valuation. So, in last, I would like to conclude with Fastenal combines strong fundamental with a scalable embedded business model. Despite the near pressures, the long-term drivers remain intact, and that is why maintain a buy recommendation with a target price of $1. Thank
All right. One of the questions that we got is from Roman is asking about how realistic is Fastenal's future growth to support your target price? For instance, he's talked about closing nearly 1,000 branches, and I'm just curious, how confident are you in your expectation of revenue?
Okay, so basically, the branches that Fastenal closed in recent terms was the ones that were not performing well or were stagnant in their total revenue. So the Fastenal is moving on towards a new model, which is the on-site locations model, and it gives a more higher and stable revenue. That is why I believe that Fastenal could generate more revenues in the current time, and thus we get to a target price of $51.
All right. Let's the sound quality is a little bit weak, so I'm gonna remove this for a second. So how does it feel to complete this assignment and this research?
Very interesting part, I believe. I learned many things. Uh, you and Mummy sir have been a great help to me these times. Like going through our evaluation boot camp from week, so it's been a great experience.
Excellent. I'm gonna take you out of this for now, but well done, and I'll see you in Slack. We had a little technical difficulty there, but excellent presentation and report by Nilesh, and that's halfway through the Valuation Masterclass Bootcamp number 24, and I would say great progress. So my name's Andrew Stotz, and I want to encourage you to build a competitive advantage in company valuation. The next bootcamp starts in 61 days. Scan that QR code and use that coupon code to get a discount that's massive. I hope to see you in the next bootcamp.